Everybody, it's Dr. Joe in the house on this wonderful Wednesday. Hope you're doing well wherever you are. Another great session lined up. We're going to talk about debt damage and disaster. What to do and how to protect your portfolio, how to protect yourself in the event of disasters, unforeseen events, and things like that. So let me get the folks on Instagram on the line. Let's see if we can get them on. Yeah, I think they're good. So let's get down to that one. And let's hold on a second. Let's get all this sorted out. Yep, I think we're good. Okay, yeah. So today I wanted to, because one of the things that a lot of investors, we focus on the analysis, we focus on all the numbers and things like that, which is good. There's nothing wrong with that. But there are unknowns when you do real estate investing. And there are fires, there are floods, there are calamities that are unforeseen, and you want to be able to survive these things so it doesn't take you out. And I don't think a lot of people spend too much time considering that, and that's why I wanted to have a session devoted to that. So as usual, I've broken the session. This time it's the 5 sections. And so it should be quite an interesting one. And as usual, before I get too far, if you got any questions, please put them in the chat box. And, I'll get to those questions in about 20 minutes. Anything to real estate investing, anything deals that or the topic that we're talking about, please put them in the chat box. And likewise, if you want to book a one-on-one with me, you can always go to my website and go to www.joeasamoah.com. And you can book a one-on-one with me where we can do a deep dive into any issues, any problems, any challenges that you're facing. And so hopefully you can hear me. Hopefully the audio is good today. There's no audio issues. Please let me know if there is. Hopefully you can hear me. I'll bring the mic a little closer. And so on. So I'm looking forward to this one. One thing I do, as you probably know, I'm different than most other podcasts, which tends to be more entertainment kind of thing. And I'm more into education and learning. And, it's kind of dry. I get it. But it's more to help you to become a better investor and so on. So, and I spent quite a bit of time researching and preparing for each of these live streams because it helps me as well. So just as much as I'm hopefully providing quality information to you, and I'm also growing myself because I'm continuously learning about real estate investing. So let's. So the question is this. Okay, introduction. So building wealth is really only half the job. Really, what good is building a profitable real estate portfolio if one uninsured loss, a bad loan, or unexpected crisis can wipe you out? Real estate investors, as you know, we're trained to look for opportunities. We're trained to analyze purchase prices, rents, appreciation, cash flow, neighborhoods, return on investments, and things like that. Yet some of the most painful lessons, and take it from me, painful lessons, it occurs after the acquisition itself. A property looked good until a major repair occurs, until an insurance claim is denied, until a tenant creates a liability problem, until interest rates rise, until a loan must be refinanced under unfavorable conditions. I mean, all those things occur. They're real. And they've taken people out. And believe me, I've seen it. So the larger the portfolio becomes, the greater the potential consequences of overlooking some of these risks. Experienced investors eventually discover, important distinction, in my opinion, between owning assets and protecting wealth. Owning assets and protecting wealth. It's all about preservation and protection of what you have. Okay, a property can appreciate significantly while simultaneously becoming more vulnerable because of inadequate insurance, excessive leverage, insufficient reserves, or financing that depends on everything having to go according to plan. Well, it doesn't. Successful investors, therefore, don't evaluate an investment solely by asking, what can I earn? No, we ask what could go wrong and how much would it cost me and how could I survive? So the good news is that risk management doesn't require predicting every disaster. It requires creating protections, layers of protection, things like insurance, conservative financing, cash reserves, proper legal operational practices. All these things are important, and you need to regularly review your portfolio to identify weaknesses before an emergency exposes them. So none of these things can eliminate you, take you out, but as an isolated event, but overall it can. And that's what we're going to do today is talk about each of the things. So I'm broken into 5 parts today. I'm going to talk about insurance. I'm going to talk about liability. I'm going to talk about debt and leverage. I'm also going to talk about reserves and liquidity. And finally, how to build a portfolio that can take a punch. Okay, so that's the 5 sections we're going to talk about today. And so let's get down to number 1, insurance. Insurance. Nobody likes to pay insurance. I get it, especially if you never use it. But it's good to have if something happens. So insurance, know what you own and what you don't. So the question becomes, if your rental portfolio suffered a catastrophic loss tomorrow, do you know exactly what your insurance company would and would not pay for? Do you know? One of the most dangerous assumptions is that as an investor is that insured means fully protected. It doesn't. Insured does not necessarily mean fully protected. You may have insurance, but it doesn't mean that you're fully protected. In these policies, in the fine print, there are coverage limits, there are deductibles, there are exclusions, there are conditions, there are endorsements, and there are definitions buried in the fine print. And that could significantly affect what happens in the event of a loss. Investors who primarily buy on premium and price alone may sometimes discover that the cheapest policy was cheap for a reason. The true test of insurance isn't how affordable it feels while nothing is happening. No, it's how effectively it responds when something goes wrong. And we don't know when something's going to go wrong. It could happen right now, tomorrow, next minute, 5 minutes, whatever. So I think successful investors become a bit more sophisticated about insurance as their portfolio grows. We examine things like replacement cost assumptions, liability limits, loss of rents provisions, deductibles, water-related coverage, vacancy restrictions. I mean, all these things are part of what you need to decide in terms of determining if the policy that you have is effective or not. Also, I think savvy investors know that insurance needs can change. Renovations, increased costs, changes in occupancy, portfolio growth, or even significant appreciation of your asset can make a difference in whether you have adequate or inadequate exposure for your insurance coverage. So the bad experiences are particularly instructive. For example, you can assume that water damage is covered without understanding that the policy itself distinguishes between the different causes of water damage, or water intrusion, I suppose. Another thing may be renovate property substantially. You could do some major upgrades to your house, but you did not update your coverage limits. Okay, so you are underinsured, in other words. So, and also think about vacancy as well. That's a good one. Some policies, if the place has been vacant for a certain period of time, whether 30 days or 60 days, then you may not have the vacancy coverage because there may be a vacancy, what they call a vacancy provision in there. Okay, because obviously if it's a vacant property, it means that there's more susceptible for, vandalism, break-ins, and things like that. So, I think the real problem is after you file a claim, not before, because most insurance companies love to take your money. The problem is what happens after you file a claim. And so you need to ask questions. You need to request explanations of major exclusions. You need to document improvements that you made to your property. You need to update the replacement values. You need to discuss changes in occupancy, keep records, photographs, receipts, leases, and maintenance information. Where you can that can be retrieved in the event of an emergency. So the objective isn't just to buy every possible coverage, no, because you can't. It may not be necessary. However, it is to make informed decisions about which risks you retain and which ones you transfer to the other party. Okay, so that's insurance. The next thing I'm going to talk about, number two, is liability. Okay, liability, the risk you can't see on a rent roll. And the question is, could one accident involving a tenant, a visitor, a contractor, or property condition put more than one of your assets at risk? Okay, could an accident take you out? Liability risk is easy to underestimate because it doesn't appear to be a standard property analysis. A spreadsheet can calculate things like rent, taxes, mortgage payments, maintenance, and cash flow, but it cannot tell you when someone will fall on a staircase, allege unsafe conditions, suffer an injury, or pursue legal action against you. You don't know. It could happen anytime. The property may be performing well, beautiful, everything's looking great until an accident occurs. And that suddenly changes the conversation from monthly cash flow to potential substantial financial exposure. So successful investors generally approach liability through multiple layers. Okay. They have adequate liability insurance on the policy itself. And but so are things like on the policy itself. And you can obviously reduce that by maintenance, documenting what you're doing, inspections, appropriate structures, whether it be entities, good contractor practices, lease provisions, and so on. So a loose railing, for example, that costs relatively little to repair, just a little loose railing, becomes an extraordinarily expensive expense if it is part of a suit, because the tenant may have told you, hey, there's a loose railing, but you're too busy. You're doing other things. You're trying to find the next deal, and it fell through the cracks, literally. And so something happened, and now someone slips, falls, injures themselves because of that railing, and they'll probably tell you, hey, we told you, you just didn't do anything. You were negligent. Okay. So now it becomes potentially a larger issue. Okay. So again, preventive maintenance isn't merely about property management expense. It's part of asset protection. It's protecting you. The bad and ugly lessons frequently begin with ignored warning signs. Ignored warning signs. A tenant repeatedly reports to you a condition, but the response that you provide isn't documented. And it doesn't get done. So be careful. Okay. Smoke and carbon monoxide detectors aren't properly maintained. That's another exposure. Small operational shortcuts can create larger consequences because liability frequently involves not only what happened, but also what the owner knew, documented, and did about it. So again, it's not what just happened, it's what you knew about it and what did you do about it and did you document it? Okay. So portfolio growth, it can magnify these issues because it's no longer just one property, it's multiple properties. So 10 properties, for example, creates more points of exposure than one. And therefore, successful investors therefore develop systems rather than relying on memory. They create inspection schedules, maintenance records, and contractor requirements, incident reporting procedures, and appropriate insurance layers. Again, as the portfolio grows, your risk management must be more systematic, not less, because your exposure is bigger. Okay, let's keep going. Number three. So I've talked about insurance. I've also talked about liability. And the other one I'll talk about is finance and how that could be a problem, especially if you're in a adjustable rate mortgage type financing that you may have. Okay, so debt and leverage when the tool becomes a trap. So the question is, are you using debt to grow your portfolio, which is fine, or has your portfolio become too dependent on debt, behaving exactly as expected? Okay. Debt is a double-edged sword. Okay, leverage is one of the real estate's most powerful wealth building tools. You can control an asset, a big asset, with a small amount of money, and so you can control $100,000 house with a $10,000 down payment, or $20,000 down payment, or whatever it is. So you got good leverage there. And so sensible debt, I call it sensible debt, can accelerate acquisitions, preserve your liquidity, and allow you to build portfolios that will take much longer to acquire if you had to pay it all in cash. That's a good size of debt. So used intelligently, financing can be an enormous strategic advantage. The burst strategy, obviously, it relies on you to buy, renovate, rent, refinance, and repeat. Okay, the idea is that you're recycling, you're taking leverage and on this asset. So used intelligently, it can be a strategic advantage. But leverage works in both directions. It's a double-edged sword. The mortgage payments don't disappear because a tenant starts paying you. The property becomes vacant or major repair occurs. The expenses are still there. High leverage can convert modest operational problems into urgent financial problems because you pay more debt. Okay, because debt service continues regardless of the property circumstances. You still have to pay the mortgage, and the question isn't simply whether a property covers its mortgage under today's assumptions. It's whether it can continue doing so if the conditions change. Some of the hardest lessons, and I've seen this for full time, financing structures that work brilliantly until they didn't. Okay, short-term debt becomes dangerous when the exit depends on refinancing, and you can't refinance. Okay, the exit depends on you selling the property, and now you can't. And now you got this debt, and there's no money coming in, and the debt is going to crush you. Another one is variable rate debt, constrain cash flows when rates increase. A lot of people got into a lot of problems this way recently. They took on debt when the interest rates were very low, 3-4%, and short term, and now they have to refinance at a higher rate, maybe 6-7%, and the cash flow is just not there. And but their debt is due. So be careful. I've seen enough people, having major problems because of this. So aggressive assumptions about future rents or property values can leave little margin for error. Cross collateralization, that's another one, or guarantees may also allow a problem involving one asset to affect another one. So what cross collateralization is that you buy a house, for example, and the lender, the numbers may not line up. So the lender will say to you, I want you to secure the loan against another asset that you have in your portfolio. So now you have two portfolios which are being leveraged for this asset that you're buying. And that's okay if all the stars are aligned. The problem occurs if you run into problems. Now you got two assets that are exposed in this new environment. Okay, so look at things like maturity dates, fixed versus variable rates, amortization, balloon payments, guarantees, covenants, prepayment provisions, and refinancing assumptions. These are things that are very, very important. The lowest interest rate isn't automatically the best. It's not. Sometimes flexibility, duration, predictable payments, and larger safety margins are worth paying for. So debt is especially in this current environment, has taken a lot of people out. I know a couple of well-known investors, especially in the multifamily space. I'm not going to mention any names. They made assumptions that everything's going to be great, but it wasn't. And now they are paying the consequences of that and so on. So be careful about debt. So far, I'm about halfway through. I've talked about three things. Okay. I talked about insurance. I talked about liability. And I also talked about debt and leverage when the tool becomes a trap. Okay. So now I'm going to go to, again, if you got some questions, please put them in the chat box. We're going to go to Q&A in a second. And anything to do with real estate, please put them in there. I'll get to you in about 10 minutes. If you want to book a one-on-one with me, you can also go to my website, www.joeasimo.com, www.joeasimo.com, and you can book a one-on-one where we can do a deep dive into anything, a topic of your interest. So let's get to number 4, which is reserves. Reserves. Okay, this is important. Reserves and liquidity. Your financial shock absorber. Reserves. Okay, it's really important to have reserves, liquidity. Okay, the question becomes, how many months could your portfolio survive if several things went wrong at the same time? Could you survive if all hell breaks loose? It doesn't usually happen that way, but it can. Are you going to be wiped out if the tenants don't pay your rent? There's a claim against you. If the mortgage has to be refinanced, all the stars are aligned against you, what is that going to do to you? Is it going to take you out, or can you be able to survive that? And that's where reserves come into play. So cash sitting in reserves can feel inefficient when markets are strong. Investors naturally want their capital working for them. Nobody wants to be having your money, your reserves in a checking account earning 0%. You want it to be working. You want it to buy more properties. You want to be doing things with it. Yeah, I get it. But reserves aren't designed to maximize your returns during good times. It's not there for good times. It's there for the purpose of reserves are to prevent investors from making destructive decisions during bad times. Consider how real world problems occur. Okay, let me give you some scenarios. A tenant moves out unexpectedly. Okay, now you got a vacancy. During the turnover, like for example, you find out the HVAC system doesn't work, so you have to replace that. Okay, and the property produces no rent, obviously during a turnover while repairs are being completed. And you still have to pay your taxes. You still have to pay your insurance. You still have to pay your utilities. You still have to pay your debt service, your mortgage. Okay. So, you may have some other repairs that needs to be done on another property elsewhere within your portfolio. So all these things are compounded at the same time. Now what? You may be crying and say, well, why me? What have I done to deserve this? Well, hey, that's just the way it is. Successful investors, we recognize that reserves buy something extremely valuable, and that is time. It allows us to stand there, be available to survive during these difficult times. Liquidity can allow an owner to repair a property properly rather than choosing the cheapest temporary fix, negotiate rather than panic, survive an extended vacancy, meet an insurance deductible, or wait to get better financing. That's what reserves allow you to do. That's what liquidity allows you to do. So cash reserves may produce unimpressive returns on paper. I get it. But their strategic value becomes very, very important during times of stress. There is no universal reserve number that's appropriate for all investors. I typically suggest maybe 3 to 6 months of reserves for each property out there. And but to a certain extent, it's going to depend on you, your property, your portfolio size, the property ages, insurance deductibles, tenant concentrations, debt structures that you may have, and the investor's other liquidity situations. So the important principle is that reserves should be deliberate rather than accidental. That's reserves. Very, very important. A lot of people ignore that. And then finally, number 5, build a portfolio that can take a punch. Build a portfolio that can take a punch. The question is your portfolio designed only to perform when things go right? Or can it survive when several things go wrong at the same time? The ultimate lesson from experienced investors is risk rarely arrives neatly in isolated categories. It's like when it rains, it pours. Okay, a storm damages a property, creating a vacancy. Insurance reimbursements take longer than expected. Revenue falls while mortgage payments still continue. A deductible consumes all your reserves. When then a loan approaches maturity, while all these things are real tricky. Okay. So, this is why a resilient investors, people who've been around for a while, like myself, been around 30, 40 years, we connect the pieces. Insurance should reflect the actual property and financing structure. Reserves should reflect deductibles and potential interruptions. Debt should be structured with enough margin to tolerate temporary income declines. And property management systems should identify maintenance problems before they become claims. Okay, so legal and accounting structures, LLCs, entities, trusts, and whatever it is, should be considered as your portfolio grows. So, really, successful investors we also conduct what we call stress tests in our portfolio. What happens if the rents decline? What happens if one or two properties become vacant at the same time? What happens if insurance increases substantially? What happens if a major deductible must be paid tomorrow? What happens if refinancing costs more than expected? These are what ifs. Okay, you can do all those analysis, or especially now with AI, you can conduct these stress tests to see how you're going to do. Individually, these questions are useful, but collectively, they reveal your vulnerabilities more than anything. So the goal isn't fear. Excessive caution prevent investors from taking action. Okay, so I don't want to scare you. The goal is to calculate your risk. Is to take on calculated risk, understanding what could happen, determining what you can tolerate, transferring risk that should be insured, retaining risk, okay, you can afford, and building enough margin for inevitable surprises. That's the goal here. So the investor who can survive the long haul, these difficult, is positioned to remain in the game long enough to benefit from the good, the bad, and the ugly. Okay, as the saying goes, what is it? In order to finish first, you must first finish. Okay, in order to finish first, you must first finish. So, in conclusion, I think I've talked about all 5 of them today. Protect what you've worked so hard to build. Protect what you've worked so hard to build. So, will the portfolio you're building today still stand when the next difficult market, major loss, or financial surprise occurs? Okay. So, long term real estate success isn't determined solely by how many properties you got, and how much equity you got. No, not always. They understand that, there's also downsides. Okay. We understand that insurance, financing, leverage, reserves, liability management, and operation discipline aren't separate administrative tasks. They're all connected together. The good, the bad, and the ugly experiences, reinforces the same lessons. Insurance works exceptionally well when until an investor discovers the loss isn't covered. Everything's great until you find out that your insurance is not covered. Okay. Leverage accelerates wealth creation until declining incomes make the debt difficult to service. Everything's great with the debt. You're taking high leverage until you get vacancies, and now you can't sustain the debt. Leverage accelerates wealth creation. Declining incomes makes the debt difficult to service. Again, refinancing creates flexibility until capital becomes more expensive or is unavailable. If you can't get refinancing when you need it, it's difficult. Cash reserves may appear unproductive until they are the reason an investor survives a crisis. So almost every risk management strategy involves the trade-off between today's cost and tomorrow's protection. New investors should develop these habits before really the portfolio becomes complicated. Intermediate investors should review whether systems that work for them when they had 1 or 2 properties remains adequate when you got a larger portfolio. And seasoned investors should increasingly think about their portfolio level, looking for concentration of risk, overlapping low maturities, large deductibles, liability exposure, inadequate liability, and the situations which one troubled asset could wipe you out or could affect multiple healthy investments that you have. But the most important lesson is that successful investors aren't necessarily those who never experience disasters. Surprises always occur. Properties break, tenants leave, markets change, insurance costs increase, lenders change their requirements, storms don't care about performers. These things are happening. So, what separates resilient investors, people who can survive the long haul, is preparation and the ability to respond without allowing one setback to destroy the larger plan. So, before evaluating your next acquisition, take another look at the property you already have. Okay. Ask a different set of questions. Where am I exposed? What am I assuming will never happen? What would hurt the most of it if it happened tomorrow? And what can I do today to reduce that risk? So, because of residential real estate investors, building wealth is only half the job. Protecting it is the other half. My friends, that's it for today in the education side. Hopefully, this was helpful. If you got some questions, please put in the chat box. I'm going to get to you in a second. Hopefully, this is interesting. Again, it's more educational, more informative. It's not, some people can see it as dry, but this is the nuts and bolts. This is the part that is not sexy. This is the part that a lot of investors overlook. And I think it's my duty to share that with you. So if you want to shoot me an email, please shoot me an email to joe@joeasimo.com, joe@joeasimo.com. Again, if you want to book a one-on-one with me, go to my website, www.joeasimo.com, and you can book a one-on-one. We can do a deep dive into any topic of your choosing. So, my friends, that's it for today. Let me see if there's any quick questions, and I'll wrap it up. Let's have a look. We have Dow 2 from Phoenix. How you doing, Dow 2? Hope you're doing well. And we also got Big Val 5023. I hope you're doing well. And we also got financial. Oh, okay. We got Mark from Hawaii. Hope you're doing well. And hope things are going well in Hawaii. So had a good week. I'm going on vacation next weekend. We're off to Mexico, Belize, and Honduras. Yep. We're going off to Central America for a week. And so I will not, well, I'll be here next week, Wednesday, but I'll leave the following Saturday. So this is my another overseas trip. And, I'll enjoy life, as they say, and the best of my abilities. But hopefully you're doing well where you are. If you've got some questions, please put in the chat box. Otherwise, I'm going to wrap it up and chill out for the rest of the evening and so on. So again, I think it's a very important topic, insurance, and how do you protect yourself from disasters that could occur and that will occur, especially if you've been around doing this long enough. Insurance costs, increasing for no reason. We have no natural disasters in Phoenix. We should have the lowest hazard insurance in the country. Well, I don't know about that, but insurance costs are rising. I mean, we're in DC. There's no natural disasters here. A lot of my premiums have gone up. But I'm glad I'm not in places like California or Florida or Texas, where they've had some real natural, or the West Coast where they're having these fires, and so on. So luckily we don't have to experience those. But I can imagine everything you worked for gone, due to some unforeseen natural disaster, and you don't have coverage. And that's really what today's topic was all about, is how do we protect ourselves from these calamities that will occur, and and they shall occur. I mean, I've experienced some of these things, and I've been able to survive that. And that's the whole purpose of today's session, was to share with you my experiences and what you should consider, as part of your risk mitigation strategy. Insurance, very, very important. Liability protection, very, very important. Debt and leverage and how that can take you down, very, very important. Reserves and liquidity, very, very important to be able to survive. And then finally, can your portfolio take a punch? Do you have liquidity? Do you have you ran the stress tests on your portfolio and try different what if scenarios? The good thing about AI is that AI does allow you to do a lot of these things now. And so before you had to go to somebody else, now you can pretty much do it by yourself and run these what if scenarios. And you can see how these things can impact you. And then you can make the necessary corrective action as necessary. So, yeah, let's have a look. I always wonder why my hazard insurance goes up every year. It always goes up. Insurance, everything goes up every year. But take it from me, Dow too. It's better to have insurance because stuff happens, and you're thankful that you have it when that stuff does happen. Because when stuff happens and you don't have coverage and you're exposed, it's not a good feeling. Or if you get the cheapest insurance, which has so many exclusions that it's really not worth the paper it's written on, that's when you realize just saving an extra $100 wasn't worth it. So anyway, seek professional advice, and there are people out there who can look at your portfolio and advise you whether you can go with other carriers, and maybe you can shop around and get the best for you, and so on. So, my friends, I'm going to wrap it up. Let's see if there's anything on Instagram. Got quite a few people on Instagram. Still killing it. Okay. Yeah, we got some no question on Instagram, but we've got quite a few people joined on Instagram. So again, I hope everyone's doing well. And so with that said, I'm gonna wrap it up for today. I think we're good. So I wish you all the best, and I'll see you next Wednesday. Take care. Have a good time. Bye for now.